Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon, and this month I'm joined by Robert Ward. You've downgraded US growth again. What do you think are the underlying factors behind this sluggish growth?
Yes, we've trimmed US growth. The main reason for that was that the government reissued Q2 data, and it was slower than it had been in the previous release. Quite a bit slower actually, under 2 in the new release and above 2 in the old release. The key things to worry about for the US, however, are, well, there's 2 of them. One is the labour market, and this looks weak, weaker than it should do at this point in the cycle. Private sector job creation is really very frail. We would be expecting a bit more action on this front under a normal recovery. I'll just give you an example. In August, the private sector created 67,000 jobs. Just to keep standing still, just to sort of take account of demographic change, the economy needs to create 100,000 jobs a month, so 67,000, well under that, and to actually grow, obviously it needs to create more than 100,000. So this is one area of weakness. The other area of weakness is the housing market. Still no sign of recovery here. The stimulus, the first time buyer tax credit has been taken away. The housing market is just, the bottom has fallen out of it. New home sales are running around 280,000 a month annualized. This is the lowest since 1960s. It really does look very bad indeed. Now, if these 2 indicators, the jobs market and the housing market, fail to rally, then we probably will be trimming our growth forecasts again.
And having pushed out the date for monetary tightening before, you're doing it again, this time to the end of 2012.
Well, this fits in with our downgrade to US growth prospects more generally. We've got the Fed funds rate being raised for the first time in the 3rd quarter of 2012 and another rate rise in the 4th quarter, taking it up to 0.75%. Still very low, of course. Overall, there really aren't any inflationary pressures to worry about in the US economy in our view. The Fed is also now worrying, I think, more about deflation than inflation. Certainly its public comments suggest that. Look at bond yields, look at the Treasury yields, for example, it's under 3%. So the markets are building in a very low inflationary environment. So we pushed out our rate rise, yes. We're also wondering, will there be more QE? I think the likelihood is that there will, if the jobs market fails to rally, if the housing market continues to look as bad as it does. So some more unorthodox policy action probably in store.
Even though the euro has shown some signs of strength of late, you still see the currency weakening on the back of debt default worries.
We do. We've got about an average of $1.30 to the euro this year, an average of $1.20 to the euro next year. We think that markets focus on one thing at a time. Obviously, they're focusing on the US, the potential for a double dip there. Once that's worn itself through, then the markets are going to be focusing back on the solvency issue in the Eurozone. The weaker countries, some of them have been issuing bonds, Portugal, Ireland, for example, but at very high rates, and the cost of this sort of debt is simply not sustainable. Don't forget also that the yields really the spread of the yields of the weaker states and German bunds really hasn't come down despite the bailout package. We're also expecting Greece to default in 2012, so this will obviously come back to haunt the euro going forward as well. So we're relatively bearish on the euro overall.
One of the BRIC economies remains buoyant in your view. You're still very much bullish on Brazil.
Brazil is the darling of the markets. Everybody loves Brazil. You've got World Cup, you've got the Olympics, you've got resources, you've got all sorts of things in store. We've revised Brazil up to about, for this year, average of 8%. It'll be the fastest growth in decades, almost Chinese levels of expansion. So Brazil's done very well. It's done well from China, from the commodities demand in China. It's done very well, and we must recognise this. Its policymakers have been battle-hardened from the crises of the 90s and the early years of this decade as well. So they're battle-hardened, they know how to deal with the crisis, and they've managed the crisis very well. There is an election in October, and the new government, one of the sort of key tests, I think, of how well Brazil will do in the future is how willing the new government is to to implement structural reforms. There's a whole range of things that need to be done in Brazil to ensure that growth remains sustainable, whether it's tax reform, whether it's benefits reform, whether it's education reform or infrastructure build out, lots of things to really do to ensure that Brazil's growth story is a sustainable, brisk, long-term one.
We've seen some food protests in the recent past, and it's very much your view that the price of basic foodstuffs is likely to continue to rise.
Yes, prices are obviously rising fast at the moment, and we've got another 4% rise in our food price index next year. This is part of the problem with food, obviously. If you have inclement weather, which we've had in the Black Sea area, so Russia, Ukraine, Kazakhstan, the wheat fields have been scorched by the sun, very, very hot summer, or in Pakistan, for example. You've had the floods, which have really trashed the cotton crop. All of these factors putting upward pressure on prices this year, supply constraints this year, which will clearly feed through into next year. Now, we are expecting a bit of pullback in 2012, partly because we assume that inclement weather sort of pulls back, recedes, and you get the supply constraints are eased. But even though we have a better supply coming on stream, and we expect food prices to fall a bit in 2012, they're still going to be elevated in comparison to what they've been in the recent past.
Thank you, Robert. Well, that was the global forecast from the Economist Intelligence Unit. We look forward to joining you again next month. Until then, thank you and goodbye.